Okay, hi guys. So this is just a overview of a lesson on the 2nd of November in terms of activity management, and it covers both chapter 30 and chapter 31 in the system book. And the system book is of course available for you to read also. But more about costs will be this focus on it. We'll talk about capacity cost and variable cost and total cost, as we also did previous. After chapter 30, you should be able to explain the concept of cost structure, difference between variable cost and capacity cost, explain different causes of variable cost, proportional, degressive, and progressive, calculate differential costs. We talked about that in previous lesson. Explain the content of differential cost. Explain the relationship between unit cost and differential cost. And explain the relationship between total, unit, and differential cost. And we're also supposed to explain the concept of opportunity cost. And explain the difference cost calculated from consumer point of view and opportunity point of view. Marginal or differential cost. We use the term marginal cost when it's per unit, while differential cost is calculated based on a range. So marginal cost is per unit and differential cost is on a range. Calculating differential cost equals to change in the total cost divided with change in the sales volume. Opportunity cost, counted profit, including cost that comes from the use of resources spent to produce the goods sold. This can both be fixed and variable. Economic profit includes cost from opportunity perspective, where the amounts that could have been earned from a different activity are included as cost, the cost of an alternative opportunity that is missed. Opportunity cost example. A company is developing a training course to a client. They have spent 80,000 DKK developing the course until now. However, the client is not really satisfied. The company finds that they need to spend additional 40,000 kroner to finalize it. Should they continue the development, having already spent DKK 80,000, they must also spend 50,000 to implement the training course. So if we see here, sales, they already spent 80,000, additional cost of the 40,000, cost for implementation, so total cost is minus 170,000. Then it will give a profit. But then if we look at the economic, sales 150,000, already used cost 0, additional cost minus 40,000, cost for implementation, and total cost. So it's the already used cost we look at it. In this terms, profit of 60,000. More on opportunity cost here. In this chapter, we'll go through this. Parameters of action, the 4 P's, the price, promotion, place, and product. Perfect competition versus monopoly, imperfect competition. Price elasticity. Activity management, pricing method, cost-based pricing. Variable unit cost plus demand for profit. Competition-based pricing, look at the competitors' prices. Demand-based pricing, look at expectation for a relationship between sales and price. Activity management, how to fix the optimum combination of sales price and sales volume. Total method, unit method, and the differential method. They all lead to the same, but it's different ways to calculate. Example, choosing sales alternative. The total methods. In this example, AS Polo produces a product called Sinus, which is sold under condition by market of monopoly. During the coming year, AS Polo has budgeted the sales potential variable cost of Sinus as shown below. Sales price, sales volume, variable unit cost. Then we see the turnover here. Variable cost, variable unit cost multiplied by sales volume. And then we have the total contribution margin here. What we look for here is the place where the total contribution margin is the highest. What you should focus on is sale price here. Is the sale price 90, and then you have a sales volume of this much. This is the place where it makes most sense for you to stop. Example with the unit method. Again, same. Then we have the total contribution methods. The unit method referred to in own book. We have the total contribution margin, but instead of just looking at the total contribution margin, we look at the, in this case, here. If we see here, total contribution equals to the area below turnover cost. Then we have the differential method, using the differential, earning differential turnover minus differential cost. Aim is to keep differential earnings positive. Differential turnover, change in turnover when sales volume is changed. So the differential contribution, as we see here, again, we then see is when we see it goes into negative here.